The National Bureau of Statistics is expected to publish the GDP figures for the third quarter of the year next week. Nigeria's GDP growth was minus 6.1% in Q2 2020, ending the three-year trend of positive but modest real GDP growth recorded since the second quarter of 2017. The Minister of Finance, Zainab Ahmed, had projected GDP growth to be negative in the third quarter, meaning the Nigerian economy is likely to lapse into a second recession in 4 years with significant adverse consequences. But the head research and strategy at Greenwich Merchant Bank, Ayodeji Ebo, joins us now for an outlook. Good morning, Mr. Ebo. Thank you for joining us on the program. So the GDP numbers are expected to be out next Monday. Are you predicting a recession? Let's bear in mind several negative projections that we've heard, including from the IMF and the World Bank.
Thank you for having me. I think if we look at the scenarios, looking at the second quarter, we all know because of the lockdown, a lot of the sectors closed in the red. But if we now look at what has happened between July and September, within that period, we saw the reopening of the domestic airport, we saw the reopening of the international airports, and also movement, and most businesses also improved. Looking at oil prices too, if you look at the average in the second quarter was around maybe $30, and comparing it to around over $40 per barrel in the third quarter. Notwithstanding, we still expect that there will be an improvement, however, still in the negative region, maybe between the 4 to 5% negative region. And the major drawbacks to some of the major sectors that should trigger this growth, if you look at the manufacturing sector, for a lot of within that space, which is a major employer of labor, most of them are still trying to balance from that supply disruptions, and that's also impacted on businesses. Also trade, we're all aware of the FX liquidity that has also impacted on trade. So by and large, if you look at most of the subsectors, will still, well, there will be some improvement, but will still close in the red. So, and for us to be technically in recession, you record 2 consecutive negative growth rates. So technically, based on what has happened between July and September, where based on estimation, we're expecting that Nigeria will still close in the red, which would will now formally be in recession, another recession in about 4 years.
Now, what if you take into perspective the NSAS protest and even the aftermath of the protests now? What do you think, or what impact do you expect this to have?
Okay, interestingly, it means we are talking about what we should expect in the fourth quarter, because the NSAS protests happened last month, and that is like a major drag on the economy. We're still in a very fragile state, trying to crawl back to that positive region. And if you take, for instance, the manufacturing sector, looking at the PMI data that tracks the activity within that space, you would see that there've been some form of improvement, though in the contraction region. However, we saw that movement for the first time since April to the expansion region, about 50 points. So we feel that the NSAS protest would be a major drag and would impact on the expectation of Nigeria recovering in the fourth quarter of 2020.
Now, when we look at last quarter's figures now, the main sector contributors to the GDP growth all settled in the negative territory, from oil refining to trade to manufacturing and even the severely battered services sector. However, when we see sectors like the ICT and the financial and insurance, they witness significant advances of 15.09% and 28.41% respectively. So what do you think is key to Nigeria's recovery, and what sectors hold growth opportunities?
Okay, thanks. I think I would like to look at it like this. What are those sectors that can help increase or can generate more jobs, and also their contribution to GDP? So if we start with looking at we know the agri space, still closed in the positive region even for last quarter, and there's been a lot of efforts there to ramp up production. But a major dent that we saw there was the flooding that would also affect harvesting because of the flooding within the northern region. Then if we also want to look at that second prominent sector that we should look out for is manufacturing, because of the ability to generate employment. We need to come up with strategies and policies that would help reduce the burden. We've seen for most of the fast-moving consumer goods, they've been able to increase prices. They've been able to pass major costs to the consumers. But what that does is also reduces the purchasing power of the individual, which we can track from looking at the inflation rate. We can see that increase in prices of the goods. Lastly, I would like to touch on trade. It's also a major employer of labor, but we all know the bottlenecks or the constraint that sector is experiencing, and that will have a major impact on the growth of also the economy, looking at their contribution also to GDP. So by and large, I think it's more of trying to focus. We've been able to identifying those prominent or priority sectors, and what are those things that do we need to do to unlock those sectors? Do it support in terms of infrastructure, support in terms of power, and we also look at policies around those places that will bring confidence for most people to expand. If you recall, we're looking at that's the African Continental Free Trade Zone taking off in 2021. How are we preparing our manufacturing companies for them to be able to position and take advantage of that, to be able to export to some of these countries? So these are some of the focus that I think we need to begin to look at now and focus more on now, which would generate employment. And we know the correlation between employment and security. We know that it's really very strong. So the more we're able to generate more employment, it would also bring down the insecurity we have in the country, and we'll be able to attract more investment into the country.
Now, let's dwell more on the manufacturing sector that you've touched on. Now, of course, you would agree that we have not actually fared well in that aspect. But do you think that an industrial plan will quicken the pace of an economic development in Nigeria?
Yes, very interesting question you have raised. Like I was talking about the manufacturing sector, we need to have that deliberate developmental plan. What do we need to do to increase manufacturing? What do we need to do to create an enabling environment such that most of the production, most of these products from these companies will be competitive? Cost of production, we know cost of energy has continued to increase, both looking at PMS and also the electricity tariff. That will impact on the manufacturing companies. When you look at to dissect manufacturing companies, the SMEs account for a major, close to 90% of that sector. So what do we need to do to continue to support them? I know government, from the fiscal angle, also from the monetary angle, there are intervention funds that have been set to support. But when you look at the quantum of those intervention funds relative to the size of that sector, it's still very minute. So it means government is limited in terms of what it can provide. Now, what will be the next step is to look at what the private sector, what can they do for us to be able to fast track in providing the distribution network, in providing the electricity. We need the private sector to come in. But before they will also come in, they need that confidence, they need that assurance that their investment will be protected over time. So it's very important that we come up with that long-term developmental program that we can begin to measure, we can begin to implement over time. And once we begin to see that impact over time, that would also be a major boost for potential investors into that sector.
All right, now let's touch on the MPC meeting of the central bank, which is scheduled for next week as well. Of course, it's the last meeting for the year. Are you expecting any major surprises?
Yeah. Yes, looking at the last MPC meeting in September, we saw that it was a major surprise to see that rate cut from 12.5% to 11.5%. But what that did was that provided some clearer guidance into what the stance of the MPC member or the CBN is. So we're all aware that, or we all got to know that this low rate interest rate environment is expected to stay longer than anticipated. We feel that at this meeting, the MPC would want to still give time to see how that the rate cut at the last MPC meeting and the increased adjustment in asymmetric corridor, how it has transmitted into growth, how it has transmitted into lending. So we expect that they would hold rates at current levels while giving more time for them to see how those things transmit into lending. Looking at within that period, if you look at the maximum lending rate, it's remained sticky downwards, still currently around 29%. Based on CBN data. But we've seen that moderation in the prime lending rate. That's the lending rate to the premium guys. So we've seen that moderation to a single-digit level. But looking at the interest rate environment at very low rates now, what would see is that the private sector would begin to take advantage of that to raise funds at even rates that are lower than the CBN intervention rates, which we feel is also positive in the medium to long term for these companies.
Now, are there any external events that you see the members leveraging to arrive at their decisions at this time? Talking about events like the COVID-19 second wave and the vaccines, the U.S. election and Iran's nuclear deal, which could ultimately see increased crude oil supply from Iran?
Interesting. That's a cocktail of events to consider. If you look at what I think the focus would be, we know how dependent dependent on oil we are. Based on the stance of the OPEC Plus and OPEC members, they are trying to keep the oil price above the $40 benchmark, so thereby adjusting output to achieve that. So we feel that if that can remain above the budget benchmark of $40 per barrel, the election in the U.S., which we are still awaiting the announcement of the winner of that election. You spoke about the second wave of COVID-19, but also the vaccine, discovery of vaccine, which is above, most of them are above 90% effective level, is also a major sign of relief. So since there's still a lot of things happening at the same time, and still want to give maybe more time till January before they make any major move on the interest rate. The focus may also need to be is on the pressure we're seeing on the private market. So we've seen exchange rate move from about 470. within the last 2 weeks to almost 480 as of yesterday. So that will be a major concern. And we're expecting that maybe there will be more policy around reducing the usage of FX for some material or some items rather, and that we feel that would also channel more pressure to the parallel market. It's more of with a supply. We need more supply at both the investors and exporters window, so that the CBN is trying its best, trying to see how they can manage the exchange rates to at least weather the storm and see whether oil price will improve in the nearest term for them to be able to have more buffers to defend the naira.
And Head Research and Strategy at Greenwich Merchant Bank, Ayodeji Ebo, thank you for speaking with us this morning.
Thank you for having me.